Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of December 21st, 2025. And this year is really winding down. I'm joined by Viper XL 007, and we are going to talk a little bit about taxes. Yeah, it seems a little strange to talk about taxes in December, but this is the end of the 2025 tax year, and we're going to kind of talk about a thing called tax loss harvesting. And is that something to consider, or what are the things that you have to be aware of as you kind of close out the year when it comes to taxes, capital gains, things along those lines? And we'll kind of just dive into a little bit of those things to consider in this week's episode. But before we hop to that, I want to give a shout out to the Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888 as well as /ViperXL007, where we post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, I don't know that taxes were something that you were considering at this time of year for an episode or for a discussion here, but it started hitting me a little bit because I like to try to get a preview of some of my tax situation. I think if you listen to past episodes from years past, you'll see that I'm kind of a weirdo when it comes to generating taxes, or at least kind of the stuff that goes into the taxes, because it's the time of year where you can kind of reflect back on, hey, what are all the things that I did? What was it successful? Was it not successful? And I am always excited about this time of year, so I'm always kind of jumping into it. In this particular year, I made some mistakes last year when it came to tax preparation and preparing for it, which we covered on an episode forever ago about that. And so I had made some changes this year to the way that I was kind of preparing for taxes by looking at my realized gains quarterly and socking away the estimated taxes based on those quarterly gains, already making prepayments to the IRS. So I've actually already made 3 payments to the IRS. But I was really kind of starting to look at, hey, what's the aggregate of all of those things going into tax season? And I started to realize something that kind of said, gee, there's got to be a better way. And what I was kind of running into was this idea, not an idea, what on paper, what I was seeing was I had a lot of realized gains throughout the year. And a lot of that has to do with how I trade, where I'm taking positions and basically I'm booking all of the winners and rolling out or kind of extending the runs on the losers to give them time to kind of percolate up into winners. And yes, I do book losses when I do those rolls, and so those are realized losses. But what ends up happening in my portfolio is I get a disproportionate weighting of I'll call it the bag I'm carrying. So these names that kind of have failed, they start to back up and build up in my bag that I'm kind of lugging around. And most of the time they empty off pretty well over time. But what that equates to from a tax perspective is it equates to very heavy realized gains and very heavy unrealized losses. So a lot of my losses remain unrealized, meaning I haven't actually sold or closed the position to realize whether or not that's a profit or a loss. So I'm basically not paying taxes and or receiving the benefit of those losses on my tax preparation because I have not realized them. So that's a concept when it comes to taxes, that you pay taxes only on realized losses and realized gains. And so I started thinking, well, this must be what tax loss harvesting is all about, because you'll hear that term thrown around at the end of the year, where a lot of times people will go into their positions, purposely book the losses, and then use those losses to offset the gains that they've had throughout the year, so that they don't have to pay taxes on those gains. Now, I've never really done this because it just seems weird to me to say, yeah, let me book an actual loss simply to avoid paying taxes that I am going to owe. It just something doesn't feel right about that. And that's what led me down to a lot of the discussion that I kind of want to have today, Viper, and go through it. But before I hop into some of those perspectives and thoughts that I've had around it and some of the conflicts I've had in my brain, is taxes kind of at the end of the year anything that you have considered in your trading or your investment area on things you may or may not doing in the name of taxes or in the light of taxes?
So it's definitely been on my mind more over the years. There, there was one year in particular where some things really took off, and I knew I was holding some positions, crypto positions that had really taken off significantly. And so it was on my mind because it was towards the end of the year that was happening. And so it was on my mind um, to intentionally manage the situation. And that was from a tax position. So, if I wanted to sell a significant chunk of that, knowing that I had very little time left in the year. So if I sold a significant chunk of that, um, I was probably not going to get an opportunity to tax loss harvest. And so I would have to take a chunk of those profits and completely set them aside to be ready for the tax bill, which isn't obviously quite tax loss harvesting, but it is how it was on my mind, especially that year. I've also seen people, some people I know in the trading space or in the crypto space that were in that same situation and they did not realize and did not prepare for that situation. So they took a ton of profits in like a December month, and then come January, February, they just kept rolling those profits into new positions, not thinking the year had already ended. And then those new positions start taking a dump and just go down, 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 down. And they're like, hey, maybe I can tax loss harvest this. And they sell at a big loss. But psych, the big win was in the year before and the big loss was in the year after. And that's kind of worst case scenario, at least as far as I understand it, because you still have that big win and then you didn't set aside money to cover taxes, and instead you put that money into new positions. Those new positions went down. Now you lost that money and you still owe money, significant money. And it's a really slippery slope, dangerous position to get in. So it's on my mind in that way of if I had a big year, if I had a big year of profits or whatever, to be mindful of December 31st and making sure that I'm aware of what's coming. And occasionally, so tax loss harvesting, to bring it back around to that, is like I haven't formulated a strategy, and to be honest, I haven't needed to formulate a strategy because I have some pretty wild swings in my portfolio. But it is something that's on my mind. I just haven't come up with the situation where I need to nail down a consistent handling of it yet.
Yeah, that makes a lot of sense, Viper. So let me talk through kind of what I was running into or what I'm kind of hitting. And we'll talk about tax loss harvesting, wash sales, and a couple other buzzwords from that. And what you'll find is this is more of a discussion episode to talk through different concepts, talk through implications of it. The subsequent episodes through the holiday season here are going to talk a little bit more specifically about my strategy that I've kind of come to in light of a lot of the reading and education and stuff that I've done on what I'm going to do, particularly for my trading aspect in taxes. We're not going to get into that in this episode. We're just going to kind of talk through some of the concepts of what they are and how they might impact you. But before we get to the concepts, let me just take you through my thought process. And all of my stuff is on thetagang.com/sprocket888, where you can see a lot of my trades. I'm going to pull that up here real briefly because what I want to show you is on this dashboard of trades, they keep track of the number of tickers and what your net premium collection is on those tickers. So these are basically realized gains that I've had. And what I want to kind of call out here is not so much the quantity or the number of the actual gain, but as I scroll down the list, look, they're all green, 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 because this is what I do when I sell premium. One, it just naturally has a high probability to win. But in addition to that, what ends up happening is I'm closing out all of the winners as winners. So it's still green, 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 green. And you get to the very bottom because this is in descending order. And then you hit a couple of the red trades. Now, what these red trades are effectively trades that these are my realized losses. These are actually realized losses. But what this is also indicative of is because these are realized losses, these are actually also still kind of open positions in my portfolio. So the unrealized losses, which are not shown here, are actually greater than these values. But what I want to call out is my strategy and the way that I trade. There is a long tail of winners and a very small number of losers, because that's kind of the holding pattern before I get rid of them. And so when you go to look at taxes, I'm paying taxes on a lot of the gains, which is cool. That's kind of what it's for. But these losses are not realized yet. They probably will be eventually, maybe, but they also might become winners. And so this is the conflict I find myself in is, do I go and close these positions just to book the losses so that I can offset all of this green that I have above here to reduce that tax burden? Because a lot of times your tax burden on the trading that I do falls in the realm of short-term capital gains, which is taxed at your income rate as income would be. So, these are going to be hit at, 30% or so to Uncle Sam. Well, the trouble I have is my strategy says I'm not done with these losers yet. So I don't want to close them. I don't want to call them out and get rid of them. But why would I not want to do that? And that brings us to one of the buzzwords that I kind of want to bring up, and that's called a wash sale. So a wash sale is effectively there to prevent exactly what you could do to harvest the losses, right? So the first thought you might have is, well, just book the losses and open up the position again so you can not get out of the position and kind of keep it going. Well, that's exactly what a wash sale is there in the rules to protect against. And what a wash sale says is, if you sell a security for a loss, you are not allowed to use that loss for tax purposes unless you wait 30 days before re-entering that position, which means if I close the books on all of these losses right now today, I have to wait 30 days before I re-enter them. Otherwise, the loss that I book when I closed is not permitted to be used to offset your capital gains. That's called a wash sale if it happens within 30 days. You're not allowed to deduct that loss as a tax loss harvest or to offset your gains. So one of the things that kind of struck me as, okay, Sprocket, why are you caring about it now? Right? I've been doing this trading now for since 2019 is really when I started. And one of the philosophies that I've had from the beginning was something that I've read multiple times is that you never really should make a trade or an investment or anything based on the tax implications of it. So I've kind of always read and been living by the paradigm, taxes are a thing that happens, but focus on your strategy, focus on your profit, focus on all of those things, and taxes will be what it will be. And don't worry about that part. Don't try to change your trading strategy simply around tax implications alone. Doesn't mean completely ignore taxes, but basically don't make that your first and foremost decision when it comes to things. However, this year it really felt a lot different because the level of gains that I have had in the year were starting to rise to a level that I considered relatively significant from a tax standpoint. Meaning, wow, let's say that I, for numbers' sake and easy math, made $100,000 of realized gains. It feels weird to turn over, say, $30,000 to $35,000 in taxes on those gains. And so that's where I was like, is this really the most efficient way to handle this? Meaning, not so much do I need to go tax loss harvest, because that just feels weird, and also potentially not beneficial, because I can't say I'm done with these trades. Tax loss harvesting to me really makes sense when you're saying, I'm throwing in the towel in Oracle, I'm throwing in the towel in whatever name it is, and moving on. Like, that makes sense to me to tax loss harvest, because you're not done with that, or you're done with that trade and you're moving on. For me, I'm not done. My strategy says you're not done with those. You're going to keep rolling them. You're going to keep selling calls against them until you get back into the green. And so for me, that would mean that I would have to re-enter the position from my strategy. Well, that negates the benefit of the loss because of the wash sale rules. And so that's when I started going down this rabbit hole of, is there a better way? What else is there for me to consider?
So one question I have, because I think you briefly mentioned it earlier, and I feel like it might apply here. Is you mentioned you make quarterly contributions to your eventual tax bill, and that's something that I really, as I continue to find my pattern, my trade style, and work on that consistency of it, I feel like that's much more impactful to be mindful of and strategic with. So I'm curious, in your strategy, and as you're now encountering this situation where you might want to incorporate some tax loss harvesting, what separates the need for the feeling of the need for the tax loss harvesting versus what you've already paid in quarterly for your tax bill? Because, like, in my mind, I'm thinking quarterly, I've been paying X amount. I'm keeping track of that. Now I'm like within a decent window of expectation. And so in oversimplifying, I feel like I would feel pretty comfortable of like, yeah, I'm good to go. Let's just see what happens and not really worry about tax loss harvesting. So what are you feeling that makes that feel more necessary now, in light or in addition to those quarterly payments?
No, that's a great call out, and I do want to mention that I think those quarterly payments are an absolute necessity, and this discussion or thing that I'm kind of arriving to is almost independent of that. Like, I think once I go through different options I have here, I think those quarterly payments are 100% necessary, and I would repeat them again, because what that is doing is that is preparing for the tax bill at the end. And it's a guesstimate, right? And the way that I do that is look at the previous quarter. So when you go to make the payment in April is one of the payment dates, right? I take what was my performance from January 1st to March 31st. What was the realized gain? Now let's just pretend that that was realized at the end of the year, and let me go put in 30% of payment to that as a tax credit to my account. So think of it like instead of putting it in a savings account that you're going to pull it out to pay taxes when it's due, it's just giving it straight to the IRS. That way it's already there. It's never in your bank account. You never have a propensity to spend it. And if you're really, really far off on your estimations, you don't get hit with extra penalties, because if you find out you're massively under withholding from the IRS, they'll fine you for that. Which I've been fined in the past, and that's one of the reasons that I started this quarterly tax payment strategy. Now, how does that fit into this debate or this discussion around tax loss harvesting and this question that I'm having? Well, doesn't fit into it because I'm not looking at this as a way to reduce my tax bill because I'm afraid of how large it will be and I might not be ready to pay it. That's not what the driving factor is here. I'm ready to pay my tax bill. In fact, I believe I've already paid 75% of it because I've done 3 out of 4 quarters of payments based on realized gains. This is more of a reflection back to go, okay, cool. Should I really be paying that much? Or is there a better way to reduce that while still maintaining my strategy? And so that's where this discussion comes from, is to say, hey, at the end of the year, if I can cut back on the realized gains through losses, then the only thing that I've done is prepay a bill that's not as high as it might be. So I feel like I've prepared for the high watermark when it comes to the tax bill. So this is really about trying to say, is there a more efficient way to pay the tax man without impacting my gains long term as much? So that is really about the what is driving my current questioning. And the theme to our blockhead traders is always ask why, understand the mechanics, understand the machine, understand all these things. So to me, there's tax loss harvesting. Okay, cool. That doesn't seem to fit with my strategy. So I started going down the Googling and the talking to your LLMs and looking into tax implications and traders and stuff like that. And that's where I started to get to this word soup or buzzwords that I'm going to kind of talk through some of these buzzwords that have come up. These are the ones that are most relevant and important into the strategy that I ended up leading with or I'm going to be incorporating. And again, I'll talk more about that in the subsequent episodes to this. But this is more about what did I find along that learning journey. And the first one is the tax loss harvesting that we've already kind of talked about. And tax loss harvesting is basically the intentional booking of losses to offset previous gains. Now, the key point here is that tax loss harvesting has to be basically a position that you are done with, or at least done with for 30 days. Because if you re-enter that position, that loss that you have booked is completely negated and not allowed to be used on your tax return by wash sale rules. We'll talk a little bit about how wash sale rules can disappear under certain conditions, because that's what I found out was that, hey, there are times when wash sale rules don't apply. And that sounds absolutely wonderful because that's my situation. Because to me, I want to book the loss and then re-enter the position and keep going, but I want the benefit of that loss. And there is a world where you don't have to worry about wash sales. We'll touch on that in a second. The other term that I really want to bring up here is mark to market. And this is a concept of a way of evaluating securities value. And you might not know this, but every day, if you are a trader and you have a brokerage account, you are experiencing mark to market. What that is when you look at your portfolio and you see a net liquidation value, that net liquidation value is based on marking your assets to the market price to understand what their total valuation is. That's the concept behind this thing called mark to market. And so when you hold an asset, right, you don't really know what it's worth. It's my father always told me, it's only worth what somebody will pay for it. And if you don't actually have an active buyer for that at the time, how do you know what somebody's going to pay for that? And that's what the market is telling you. The market is telling you this asset is currently selling for $5, $10, $20, right? So they can presume that what you're holding is worth some value based on how much do you have multiplied by what is the current market value. So mark to market is a way of expressing the value of your portfolio when you take those positions and apply the current market price to it. And I'll talk about how that kind of comes in to a special type of accounting where you can do mark-to-market accounting on your positions. So the next one is trader tax status. And this is what I'm going to say is the magical thing that makes all of this stuff go poof, disappear. So, trader tax status is a thing that you can apply from the IRS to yourself as a personal entity, to your Social Security tax ID, or it's a thing that you can apply to a company or an LLC. But it's basically a designation to the IRS that says, "Hey, I am a trader and I want a trader tax status." And if the IRS recognizes you as a trader tax status, you are now opening a whole new world of tax implications and tax ramifications. So when I talk about making wash sales disappear, if you actually have a trader tax status with the IRS, wash sales don't apply to you. You can book as many losses as you want, and you can immediately re-enter that position, and those losses count as losses in your tax situation. The wash sale rules do not apply to people that have a trader tax status with you. Now, one interesting thing about a trader tax status is, surprise, surprise, you actually have to qualify as a trader. So you can't just take yourself that you might have a bunch of investment portfolio and you're a buy and hold type person and say, you know what, IRS, I would like you to give me a trader tax status. Because what they want to see is they want to see that you are an active trader. You are buying and selling positions daily. You're making money on short-term moves. You are not investing. It's not investor tax status. It is trader tax status. And so the scope and how you trade largely determines whether or not you even qualify for this. So you can't just show up one day and say, yeah, I'm a trader, so tax me like a trader, please. You actually have to have the data to back up what your claim to being a trader. Now, the last one is actually, it's called Section 475F. And this is a specific and distinct election that you make to the IRS that basically says, hey, IRS, I am going to apply mark-to-market accounting for my trades. This is where you step up and you are saying, do not tax me like regular capital gains. I want my positions taxed mark-to-market. This is something that I think is one of the avenues to really make this this tax loss harvesting not apply to you. So what that does is it says if you are being a 475F election, if you're saying I elect to do mark-to-market accounting, that says at the end of the year, it doesn't matter if you've held a position for 5 years, 5 minutes, 5 months. At the end of the year, your entire portfolio is mark to market. So the valuation, all of your unrealized losses are realized on paper. All your realized gains are realized on paper. You add all of that up and boom, there is your tax due. So it's like compressing all of that stuff saying, pretend I sold it, even though I didn't sell it, and prepare my taxes as if I did. So everything is realized at the end of the year as the entire portfolio is marked to market. So you might think, well, oh my gosh, Sprocket, duh, just do mark-to-market accounting. Why wouldn't everybody do that? That solves all the problems, right? You get to book all the unrealized losses against your gains, and that might appear that way, but there is a drawback to mark-to-market accounting, and that is basically if you're a buy and hold guy and you end up having long-term capital gains and long-term capital losses, you completely lose all of that benefit. So what I mean by that is, let's say I'm building up a position in Apple, and I've been building it up for 5 years, and I do mark-to-market accounting. When I go to sell that Apple position, I would be taxed at a long-term capital gains rate. So long-term means you hold the position for more than 1 year before you realize the losses. And that long-term capital gains rate is significantly lower, or can be significantly lower, than the short-term capital gains rate. So short-term is taxed at your income. Long-term is taxed at like 12% or something like that. So if your income bracket is having you taxed at 30 to 35%, and you do mark to market, when you sell that apple, or if you don't even sell the apple, you pay your unrealized gains on that every year at 35% or 30%, versus if you do the traditional accounting and the traditional capital gains method, then your gain is done at the long-term rate of 12% or 15% only when you sell. So you see where it's kind of going. You're paying a whole lot of extra tax if you go mark to market on long-term holdings, and you cannot mix and match. So you're either doing capital gains calculations or you're doing mark to market taxation. You cannot say, "Oh, please tax these assets this way and these assets this way." And that there is where the rub and the complexity can kind of come in. So in this trade-off that I'm talking about, that is a really big distinction that you have to give consideration to. Because if you are doing mark-to-market accounting, then every single year, at the end of the year, you take your entire portfolio, you mark it to market, and whatever its net valuation is relative to the last year, that's what you're going to pay in taxes. So if you take your whole portfolio and your net positions, say I am net plus $40,000, that would incorporate $40,000. That would take all of your unrealized gains, all of your realized gains, all of your realized losses, all of your unrealized losses, smash them all together into one number, and then you would pay your income tax rate against that number annually. Makes it pretty simple. But if your portfolio consists of stuff that you're not selling because you want to hold on to them for more than 12 months, then you are basically forcing yourself to pay taxes annually on the gains and losses of that holding before you ever realize them. And so I think your portfolio composition has a ton to do with this. Now, my portfolio composition is 95% options trades, short-term trades. Like I went through and I looked at my average trade duration. My average trade duration in 2025 was 14 days. 14 days is the average time that I'm in a position. Sometimes a little bit more, many times a little bit less, but I don't have a big bucket in my brokerage account that says, "Oh yeah, here's my Apple that I'm accumulating over time. Here's my Intel that I'm accumulating over time." So for me, I'm not conflicted that much with regular capital gains versus mark to market, because every year, everything is always a short-term gain, capital gains tax, because I'm not holding anything anywhere near a year, as my average trades are only 14 days. But Viper, you kind of get some of the concept here of the capital gains benefit to longer term holdings, and then the mark to market benefit if you're short term. But I'm curious, in your portfolio composition, do you find yourself having a lot of buy and hold or a lot of position accumulation? Or do you have a lot of short-term trades? You're a majority in there, or maybe you're just a mix of all kinds of things.
I'd say I'm overwhelming majority short-term trades. So the option strategy I've talked about, that's a very short-term, never holding much longer than 21 days, 14 to 21 days. Any of the long-term hold stuff, I usually put into one of my retirement accounts that I manage. But that's a completely other tax situation in there. So that's not really one I worry about. So I'm definitely much more in that short-term camp.
Okay. So this would be something that potentially would really benefit you, or could benefit you depending on the magnitude and size of the trades. that you're doing. It's an important call out because I'm very similar to you, where if I'm going to buy and hold a position or build a position over time, I'm leveraging my retirement accounts because I'm not really using this brokerage account for anything more than kind of the quick turn. I'm not ever saying, hey, I want to build up some wealth in this brokerage account because I want to cash out in it, in 5 years or whatever before retirement, right? My whole plan around a lot of this is to build income for retirement. And so when I have buy and hold things, I'm like, yeah, put that in that retirement account because there's no taxes in there. So that's like the most tax advantage. Now, the drawback is you can't pull it out, but that's okay. I want it to be in there for many years. So it makes sense for me to kind of relegate that stuff away. And that's one of the things that kind of facilitates that short-term focus on my brokerage account. Now, there's one last topic before we wrap it up this week that I want to call out. It's one big snafu or caveat that I ran into in all of my research. I'm like, perfect. No wash sale. Well, sorry. The elimination of wash sale rules actually comes about if you have trader tax status, which we can get into a little bit, but not so important because honestly, the mark to market kind of takes away the need for wash sales because you don't need to sell anything to get that final tax bill. But you might think, perfect. When you go to file your taxes, Sprocket, just do mark to market. What's the big deal? You found the way out. Just do mark to market. Well, that's where the rub comes. That is that beautiful section 475F. That has to be filed with the IRS before the completion of the tax year. So the IRS doesn't say, you know what, buddy, why don't you go through the whole tax year and figure out which method of accounting is best for you. They basically say, if you want to go through that 475F mark-to-market election, you have to do that by April 15th of the tax year that you want to benefit from it. So for me to use mark-to-market accounting in the 2025 tax year, I would have had to have filed a Section 475F with the IRS when I turned in my 2024 tax return. So that would have been April 15th, 2025. So I didn't do that. So I do not have the luxury of basically doing mark to market for the calendar year of 2025. If I want to do mark to market in 2026, I must have that form to the IRS by April 15th, 2026. So they thought of everything, and I'm not able to capitalize on that this year. So Viper, that's going to bring us to the end of this week's episode. That is a whole lot of words and definition and impact. And you're probably like, oh my gosh, what is the relevancy of all of this? How is this practically applicable? You might be very intrigued by it. So fear not. There shall be follow-on episodes in the coming weeks. Basically, the next episodes I'm going to dive probably solo on some of these topics to talk about what am I actually going to do in my 2025 tax year? What am I actually doing as 2026 comes up? How am I doing it? What is the actual tactical thing that I have to complete, have to do? What did I what did I look at to arrive at that decision, that approach to taxes? So that is going to be upcoming. Really, the takeaway from this episode, in my opinion, is don't just put off taxes as a thing that happens. At some point, you're going to look into, okay, it's time to try to optimize it. I think that is going to happen when you reach a certain threshold of income and profit from your trading. So yeah, you could say, oh, I need to learn all these things when my net profit is $1,000 for the year. But honestly, you can do it. There's no drawback to it. But I think it becomes more relevant and more applicable to you the larger that number gets. From a percentage basis, it should have the same impact no matter what. I think you'll find that certain aspects as we dive into future episodes might hinder your ability to reach certain things as we get into trader tax status. It's very likely that if the end result of your year is really, $1,000, $5,000 profit or loss, you're probably not generating the amount of trades that the IRS would expect to qualify for a trader tax status, simply because you're just not kicking around enough capital to make enough trades. You might be, but it's more likely than not that it's probably not big enough. So I think once you reach a certain point in your capital gains, that's what's really going to trigger some of this stuff. But you might just be curious. And so I think a lot of these words and concepts are things you can look into. You can tune in subsequent episodes as I dive more into these individual topics and how they pertain to me and the decisions that I make. You can use that as a data point for your very own world and how they will apply to you. So good luck out there as the year kind of winds down. Consider your losses, or consider booking some losses to offset some of your gains, because once December 31st passes, you can't book any more losses for the calendar year of 2025. So it is kind of a hard line, time-bound thing, and there's only a handful of market days left this year to make those trades, to book losses. So this is the time of year to think about your strategy for a particular tax year, on if you're going to do anything as the year closes out, or if all of your prepared preparations are adequate for you and you don't need to mess with them in the future. So good luck out there, have fun, and remember, think outside the block.